International monetary policy is an essential part of international economics because transactions in the global economy depend on the availability of money and credit. International monetary relations and financial transactions, specifically monetary flows and cross-border currency competition, have a major role in reshaping the global economy. Therefore, it is necessary to discuss the balance of payments, which explains the overall financial position of a country. Balance of payments records the debit and credit transactions that a country has with the rest of the world. It is comprised of two main items: the current account, which includes all transactions related to a state's expenditures and revenue, and the capital account, which includes the flow of financial capital into and out of a country. The total of a country's current account, capital account, and change in reserves always equals zero. Although the balance of payments account should always balance to zero in theory, countries can have payment difficulties. When a country has a balance of payments deficit, it increases its liabilities and/or loses its official reserves. A country often seeks to offset these losses with foreign investment and/or an inflow of funds into its capital account.
There are many reasons for the Greece financial crisis. Greece had been living beyond its means for many years. The main cause of their financial crisis is its corrupt government and government failure. Greece had been dishonest to the European Union about their financial status so that they can meet their requirements for a European Union membership. After receiving full membership, Greece received grants and loans from other European countries such as France and Germany. Greece borrowed more money than they should have. Greece's income was affected by tax evasion. People and businesses weren't paying their taxes, so Greece's revenue was hit the hardest. After many years of excess spending, their deficit became too much to control, and Greece was unprepared for the financial crisis when it hit. The debt became too high for Greece to borrow money to pay off their debt. Instead of the government using the money they borrowed to fix the economic problems they had, they became greedy with the borrowed money. Public sector wages rose rapidly in Greece, rising as high as 50% between 1997 to 2002. Greece's current debt is 133% of its $306 billion GDP. Their total debt is €327 or $407 billion. Next, nations that loan Greece money must now accept that they may not get their money back.
Governments opting for adjustment rely on monetary and fiscal policy instruments. Monetary policy influences the economy through changes in the money supply. Specifically, a central bank limits public access to funds for spending purposes and makes such funds more expensive. The government uses fiscal policy to deal with a payments deficit when it lowers government expenditures and raises taxes to withdraw purchasing power from the public. The combination of monetary and fiscal policies depends on whether a country opts for external or internal adjustment measures. External adjustment measures impose most of the adjustment costs on foreigners through tariffs, while internal adjustment measures cause individuals and groups to pay the adjustment costs domestically through higher taxes and higher interest rates. However, a country may also seek financing for its balance of payments deficit by borrowing from external sources or decreasing its foreign exchange reserves. Financing is often the preferred option when access to credit is available because it is easier to postpone difficult adjustment measures.
Austerity refers to a policy of deficit cutting by lowering spending via a reduction in the amount of benefits and public service provided. Austerity policies are often used by governments to try to reduce their deficit spending and coupled with increase in taxes to demonstrate long-term fiscal solvency to creditors. Austerity measures are taken when government cannot honor its debt liabilities. In May 2010, the European Union and IMF provided €110 billion of bailout loans to Greece to help the government pay its creditors. It soon became apparent that it would not be enough, so a second €130 billion bailout was agreed earlier this year. As well as these two loans, which are made in stages, the vast majority of Greece's private creditors agreed to write off more than half of the debts owed them by the Athens. They also agreed to replace existing loans with new loans at a lower rate of interest. However, in return of all these loans, the EU and IMF insisted that Greece embark on a major austerity drive involving drastic spending cuts, tax rises, and labor market and pension reforms. Without economic growth, Greece cannot boost its own income, so it has to rely on aid to pay its loans. The Greek parliament narrowly adopted a new round of austerity cuts that are required for Greece to receive the next installment of crucial international economic bailout. The cuts have provoked ire among Greeks furious about the effects of multiple rounds of belt tightening, which have resulted in cuts to pensions and pay. They have seen unemployment soar to more than 25%. It is Greece's fifth year of recession. More than one-fifth of the population could face poverty, defined as a family of four on an income of €13,842, about $17,500 per year. State news agency AMNA has reported. The austerity bill sets out reforms and fiscal measures worth €13.5 billion over the next 2 years. It will raise the retirement age from 65 to 67 and cut pensions on average between 5% and 15%. The thorniest issue is that of the labor law changes. The bill gives the government the right to set the minimum wage as of April 2013. It also reduces the redundancy notice period, the time given to workers to leave their jobs after being laid off, and it limits compensation for workers with more than 16 years of service, as well as allowing stores the risk to ask employees to work more flexible hours. What happens next? When Arthimis Samaras, Prime Minister of Greece, New Democracy, won the general election in June, he insisted Greece did not need a further bailout but wanted a 2-year breathing space to meet tough budget targets attached to the bailout from the EU and IMF. Greece has now been granted the extra time, but major problems remain. The financial markets are still nervous. If Greece's economy continues to contract sharply, the country may not be able to repay its debts, meaning it will need to further help. If the rest of Europe is no longer willing to provide it, then Greece may be forced to leave the euro. There is, of course, the possibility that Greek people, fed up with rising unemployment and falling living standards, will make it impossible for governments to continue with austerity.
Why does this matter for the rest of Europe? It matters a lot. If Greece does not repay its creditors, a dangerous precedent will have been set. This will make investors increasingly nervous about the likelihood of other highly indebted nations, such as Italy, or those with weak economies such as Spain, repaying their debts. If investors stop buying bonds issued by other governments, then these governments in turn will not be able to repay their creditors, a potentially disastrous, vicious circle.